I personally want to thank you for being here. We do have question cards on the table, so as you're getting the information from our two presenters today, please feel free to write down those questions for us, and we will have people that will come by and pick those up. We are allowing quite a bit of time for Q&A afterwards. And I hope you brought notepads to be able to go ahead and take some notes on everything they have to share. I'm sure both of you will be available afterwards to meet with people one-on-one to answer their personal questions. So that's great. I also want to welcome the new folks that are not members of the Oregon City Business Alliance. We have membership applications on the table, and I'm just going to read to you real quickly what the Oregon City Business Alliance mission and some of our objectives are. If you give me a moment. So our purpose is to attract, build, and keep businesses in Oregon City by educating the voting public about economic issues, influencing public policy, and encouraging qualified individuals to run for local public office, commissions, and committees. Our objectives are to build strategic relationships with the business community, civic leaders, and elected officials. And our values, the Oregon City Business Alliance values and promotes free enterprise principles, including economic diversity, equal access to economic opportunity, responsible growth, private sector jobs, business-friendly policies, integrity in dealings with public officials, and transparency in all efforts to influence public policy. So the one thing that we are excited and proud of is everybody's welcome. We want everyone to be here. We are non-political in the sense that we're one party or another party. We encourage everyone to participate and engage in the conversations and discussions. We welcome that. The only thing we ask is that you're respectful to our speakers, you're respectful to the other people that are here at the events, and I think that we can all get along and learn a lot that way. So today, we are privileged and honored to have two very, very well-qualified speakers on the topic of opportunity zones. Ian Galloway is the director of the Center for Community Development Investments and the Oregon Community Development Regional Manager for the Federal Reserve Bank of San Francisco. Ian researches and presents regularly on a variety of community development topics, including crowdfunding, investment tax credits, the social determinants of health, impact investing, opportunity zones, and pay for success. So very excited to have you here, Ian. Our other speaker is Stephen Brooks. Stephen currently serves as the director for the Oregon Opportunity Zones Initiative, developed with the support of the Meyer Memorial Trust, the Oregon Community Foundation, the Ford Family Foundation, and Business Oregon. The initiative provides an actively managed clearinghouse that links investment-ready projects in rural and underserved communities to local and national capital markets. So thank you, Stephen, for being here as well. But before I bring them up here, I just want to acknowledge some of our elected officials that we have here. I see Commissioner O'Donnell. Thank you for coming. And former Commissioner Brian Shaw, over here. Former Mayor Lou Ogden. Thank you. And former Mayor Dan Fowler, who also owns the Abernathy Center. Did I miss anybody? If not, I stand corrected. Okay, with that being said, I think we're going to start off with Ian. So we'll give you the podium.
Thank you, Kent. Thanks, everybody. So I'm just going to kind of wander around here. I don't like standing behind those things. So thank you for having me today. I'm very excited to tell you a little bit about opportunity zones and some of the upside and potential downside that I see coming with this program. I'm going to give sort of an introduction of what opportunity zones are and opportunity funds. Talk a little bit about the benefits to investors, benefits to communities, and then talk a little bit about the potential negative impacts on low-income places if we're not careful about how we use this tool, and then hand it over to Stephen, who's going to take all of the difficult questions that you have related to the program. There's a lot of detail, a lot of technical aspects of it that are still being worked out. So this is a great time, I think, to get engaged with this program. Because we're being recorded, I have to, the obligatory, what I say does not necessarily reflect the views of the Federal Reserve. They're just my views, for better or for worse. And so let me just launch into this. And I'll try to get through this as quickly as possible, because I suspect there'll be lots of questions. And I don't know if maybe we'll do questions after Stephen goes, and we can both respond as needed. So this is, as I mentioned, kind of what I'd like to walk through with you. Of opportunity zones in the first place, right? Why does this exist? Why could this potentially be a good tool to revitalize disinvested parts of the country? So there's quite a bit of research that actually indicates that where you live, where you grow up, is enormously predictive of your economic mobility. So if you live in one of the redder parts of the country, it's very unlikely that you will move up the income ladder, or that your kids will advance up the income ladder. But if you're in more of the bluer counties that you see here in the country, you're more likely actually to advance from an economic mobility standpoint. So it seems like place is an important determinant of your long-term financial well-being. So that's the basis of opportunity zones. What if we could create a tax incentive to invest in disinvested places, to restart them and give more people access to upward economic mobility? So that's the sort of theory of change driving the program. It was part of the tax reform bill that passed at the end of 2017. Opportunity zones have actually been discussed in Congress for several years before this legislation passed. It just ultimately ended up being part of the tax reform bill. And there's two sort of program elements that I want to talk about a little bit today. The first is the zones themselves, what they are and how they came to be. And the second is opportunity funds, which are the investment vehicles that will invest in designated opportunity zones. So the zones are all low-income census tracts, with some exceptions. We won't go into the detail unless you want to. There are some zones that are adjacent to eligible zones and were still qualified under this program. They're very few, although I think you actually have one here in Oregon City, interestingly. The vast majority of opportunity zones are low-income census tracts. That's a federal definition for those of you in the community development field. It's the New Markets Tax Credit definition. You can look these up online, go to the CDFI fund, and they will give you a technical definition of what qualifies. They'll also give you a map of all of the opportunity zones across the country, of which there are about 8,600. So every governor of every state was given the opportunity to designate up to a quarter of their low-income census tracts in their state as an opportunity zone. So if you're just thinking about the whole country, that means 1 in 4 poor neighborhoods is probably now a opportunity zone. So that's an important thing to keep in mind. These designations last for 10 years until the program actually sunsets or is renewed by Congress. So once the designation is made, regardless of what happens to the zone, whether it becomes richer or poorer, it remains an opportunity zone for the duration of the program, which is 10 years. So this is the map of Oregon. We've got 86 opportunity zones across the state. The lion's share of those are in the Tri-County area here in Portland Metro, 31. And this is Oregon City. So you have two designated opportunity zones. One is what they call a contiguous tract designation, which is not technically a low-income census tract, but still qualified through the rules. And the other is a more conventional low-income census tract. So you know your community much better than I do, but I believe that the one to the north includes the Willamette Falls development, and the one to the south, I believe, does not. Somebody tell me if I'm wrong. So those are the zones. So they've been designated. They were designated last year. They're set in stone for 10 years, earlier this year. And they won't change, as I said, for a decade. So that's where you can invest. How you can invest is through something called an opportunity fund. And the best way to think about an opportunity fund is an investment vehicle that solicits rolled over capital gains from investors that would otherwise pay capital gains taxes. So you buy $1 million of Google stock and you sell it for $2 million, you suddenly have $1 million of capital gains. You can either pay the capital gains tax on that, or you can roll it over into an opportunity fund. And then that opportunity fund invests in opportunity zones, either in real estate or in qualifying businesses. Those funds can be managed by anybody. And this is one of the things that I like to encourage community groups to think about. It doesn't have to be a bank or a financial institution or an investment fund. It could be a business alliance. You could set up your own opportunity fund, solicit rolled over capital gains from people in the community, and then invest in strategic priorities in Oregon City, for example. So the barriers to entry to create a fund are very low. So I'd encourage you to think about creating your own fund if you can't attract another fund to invest in your own community. So the benefits to the investors, so these are the underlying folks who rolled over their capital gains. There are sort of myriad here. The best way to think about it is sort of 3 different types of tax benefits. One is the deferral. So you've rolled over your capital gains. They are being invested by an opportunity fund in an eligible way. As long as that is the case, you do not pay taxes on that underlying investment. So the $1 million that you rolled over, you do not pay any taxes on that as long as it's in an opportunity fund. There is an expiration to that, and it's December 31st, 2026. So at that moment, regardless of what is happening with your investment, you have to pay taxes on that original $1 million. Right? So that tax bill will eventually come due. Now there are an additional 2 benefits associated with the program beyond just the deferral. One is if you keep your money in the fund for 5 years, then the total amount that you are paying taxes on actually decreases by 10%. So that $1 million, let's say it's deployed for 5 years, when you do pay taxes on it, you're only paying taxes on $900,000. So it's gone down 10%. If you keep your investment in an opportunity fund for an additional 2 years beyond that, so 7 total, it drops an additional 5%. So you're only paying taxes when that tax bill does come due on $850,000. And then the last benefit is probably where the most value is. And that is if you can keep your money deployed in the fund in an eligible use for a full 10 years, then all of the capital gains that have accrued over the course of that investment are tax-free. And that is true until 2046, at which point you will eventually, the tax benefit runs out. But until 2046, you pay no capital gains tax on any of the underlying capital gains that accrue on your investment. So that's potentially the largest tax benefit associated with the program. I know you probably can't read this. I stole this slide from the internet. It's I think, a good illustration of why you would invest through an opportunity fund versus through a more conventional fund. On the left is sort of a conventional fund and the expectations on return, particularly the tax benefits. And on the right is what would happen if you took the same investment and put it in an opportunity fund. There's a ton of assumptions associated with this. I really want to highlight the fact that this is not intended to predict anything. It's just an illustration. And this was borrowed from Skybridge Capital, who is an opportunity fund investor. And as you can see, you start out with $1 million. You have sort of an assumption of an 8% return. In a standard investment, you'd first of all have to pay that capital gains tax bill. So the money left over is smaller, obviously. So your opportunity to make money on that is smaller. So your gains are less. And then you also, when you do exit, have to pay capital gains tax on the capital gains that have accrued over this 10-year period. So this assumes a 10-year hold. Compare that to an opportunity fund investment. Same assumption in terms of returns, but you're not paying taxes on the initial investment principal. You eventually have to, but it's reduced because of those benefits that I talked about before. And you're not paying any capital gains on the underlying investment over the course of the 10-year period. So that constitutes about a $620,000 difference in potential returns going through a structure like this as opposed to a conventional structure. But as I said, this is obviously just for illustration, just to give you a sense of what the trade-offs are. So I think there are benefits to communities potentially with this program. I think that historically communities have, disinvested communities have had trouble raising equity investment from the market. This creates a incentive for equity investors to care more about these places than they have historically. So I think that's definitely a plus. I think that the fact that this is a place-based program aligns really well with sort of state-of-the-art community development practice, which is that we're much more successful executing anti-poverty programs when we concentrate on a hyper-local place instead of spreading finite community benefit and community development resources across a larger place. If we focus on neighborhoods, if we focus on communities, we tend to get better results. So that aligns well with the opportunity zone structure. The low barrier to fund creation, I think, opens up lots of opportunities for nonprofits, community groups, business alliances, economic development agencies to create their own opportunity funds and execute their own local strategies to advance the community. And there was a public process that went into designating the zones. So presumably some communities advocated to be included. And so this is an opportunity for them to take advantage of the program. But it's not all rosy. So there are very few guardrails around this program. And I think Stephen will go into sort of more of the specifics about how an actual investment comes together and the benefits. But there's very little reporting. As long as you sort of invest in a qualifying business or invest in a qualifying real estate development, it counts, regardless of if it advances some community goal or community development objective. There's significant gentrification risk. This is creating an additional incentive to invest in places that may already be gentrifying. I suspect you all read the Oregonian coverage of opportunity zones and the fact that most of downtown Portland and inner northeast Portland is an opportunity zone, which is would not necessarily be at the top of my list of places that are starving for capital. So this will probably just accelerate some of those gentrification trends and ultimately lead to some displacement of both businesses and families. So I think this is a friend of mine at Northern Trust Bank who is very interested in opportunity funds but is weary. And she says, look, we want these funds to be used by communities. We don't want communities to be used by opportunity funds. So that's sort of a stance that I agree with as well. So just a quick sense of the potential gentrification and displacement risk. This is a little bit dated. I think it's a couple months old. But as you can see, or I hope you can see, the green line is sale price of opportunity zones that were ultimately selected. The yellow line is eligible zones that didn't get selected in the end. And the red line is census tracts that were not eligible to become opportunity zones. As you can see, from the moment that the program is created and from when the opportunity zones are actually designated, you see a substantial increase in value for the opportunity zones that were ultimately selected. This is just one data point, but it's obviously trending up pretty fast. And the concern is that this is going to price out a lot of people who happen to live in opportunity zones. So just to wrap up, I think this has the potential to be a valuable program for low-income communities, but I think we need to be thoughtful about how we use it. I think the more we can create impact-oriented opportunity funds, the better, who are actually executing stated community goals. I think if we can all contribute to a statewide database in terms of who's investing in what, that will give those of us in the research community a lot more data to evaluate the effectiveness of the program. I think we know that there's going to be gentrification and displacement in a lot of these places, and even if we're not using an opportunity fund structure to invest in those places, we can start preemptively purchasing, acquiring community assets that are important to the community to make sure that an opportunity fund that does not align with the values or expectations of that community doesn't come in and purchase those assets and repurpose them in a way that does not advance the community's goals. I think that because there is a substantial tax benefit associated with the program, we can have a conversation about lowering our return expectations, particularly if you're talking about an impact-oriented fund. The more we can engage the community, I think the better. That's started in a lot of places, but we need to do more of it. And I think it would be such a waste if we didn't think creatively about how to use this program. You know, I mean, I think we've read about the handful of real estate projects in downtown Portland, the Ritz-Carlton among them, that have been funded by opportunity funds. That's not a creative use of this program. And I hope that we think more creatively about how to deploy opportunity fund dollars in conjunction with existing community development resources, whether it's tax credits or CDBG or foundation investment. I think we need to be more creative if we're going to get the most out of this program. And I think that's it. And that's my contact information. I'm happy to answer any questions here at this forum and certainly reach out afterwards. This is a topic that Stephen and I talk about a lot. He's the expert, but I'm happy to follow up on any of the community development implications that are interesting going forward. So thank you all very much for the opportunity to speak.
Well, thank you, Ian. And since he mentioned that the Business Alliance can go ahead and start one of these funds, I think we should go ahead and do that. The Oregon City Business Alliance is open for business. So anybody who wants to write a check into our fund today before you leave, we'll be over here in the back of the room, and we'll have a little pot that you can go ahead and put your check in. So don't leave until you talk with us. All right, some good information. Will we be able to have access to these PowerPoint slides? Okay, I know we dimmed the lights a little bit to make them a little bit easier to see, but a $600,000 differential on the same investment is pretty substantial. And I like that 10-year period where there you pay no capital gains tax on that investment. All right, with that being said, Stephen, do you want to have the floor now? And I think you're going to go through some examples.
Yeah. Thanks very much. Again, appreciate being here. As Ian said, I'm kind of on the execution side of this program, but I'd like to do something a little different than what I've done in the past. As Ian was saying, and as mentioned before, about a year and a half ago, I was hired by 3 local foundations to try and figure out how to take a program that's really, if you think about it, the least friction in terms of money moving into projects is opportunity zone money moving into commercial real estate development in large urban areas. It's just if you're an investor, that's the bright shiny thing, and if you can put money in those projects and get a big capital gains tax break, that's the easiest thing to do. We recognized pretty early on that in order to redirect some of that capital into smaller communities and rural areas, there'd have to be some kind of intentional program in place to make that happen. And again, Ian had talked about that on the creativity side and reaching out to communities. So I was hired to really try and develop a program to put that in place. Over the last year or so, I've done a lot of presentations to local communities. The presentations usually go, you get an accountant or an attorney up and they walk through the technical details, and then people get really tired. And then, and then I get up and I kind of talk about the structure of our program. And then the afternoon ends and people are like, oh, that's really great. What do I do? And then we have to come back So what I thought I'd do this time is instead give some very high-level information about how these kinds of investments are structured, but not in a real technical detail, and then really kind of see if we can get an example or two and see if we can identify different groups of interest parties in this kind of environment and really work through some examples so that people can see kind of how the rules translate into on-the-ground activity. So to start with, what I'd like to do is give a pretty high-level idea of how the program works. Ian already gave a brief example. To start with, there are, in any opportunity zone funding project, there are three parties. So there's the investor who puts money into a fund. So you have the investor, and then you have the fund, and then you have the business or real estate development project that's looking for capital. It's important to keep in mind that if you're the business or the developer, you're actually looking to a fund to invest, not to an individual. And so that's something that will come up as we talk a little bit further. Just to kind of walk through an example of how this works is, you take your Google stock owner, buys Google stock for $1 million, sells it 2 years later for $2 million. So they have $1 million gain. To take advantage of the program, you put that $1 million gain into an opportunity fund. Now, technically, you, as the stock owner, can create your own fund. So it's not that complicated to have a fund. But you put the $1 million into a fund, and then the fund has to invest in a qualifying project. And what that generally means is that you either have to invest in stock or ownership interest in a company or in a tangible asset. In either case, the investment has to be in a new asset, which means if it's a business investment, the money has to be for business expansion, purchase of new facilities or equipment. It has to be for some new purchase. It can't just be to buy out a current owner. If it's an investment in a real estate project, it has to be for new development. That can mean redeveloping an old building, but if you do that, then the amount you put into the building in redevelopment costs has to equal the value of the building itself. So for example, if you buy a building for $1 million and the land is worth $100,000 and the building is worth $900,000, the fund has to invest another $900,000 into the rehab of the building itself. It can't just be, putting in new windows. It has to be pretty extensive work. So for our purposes, that's kind of the broad sense of what you do. If you're the investor, if you're the person looking for the tax break, you have to sell a capital asset and place the gain from that sale into an opportunity fund. You have 6 months to do that. So if you sell January 1, I shouldn't give dates because I can't count that well, but you have 180 days. So if you sell your stock, you have 180 days to put your money into a fund. Then the fund essentially has a year to put at least 90% of that money into either a business investment or a real estate development. And then the real estate development or business has 30 months to put that money to work. So there are some timing issues about how all this works, but it's basically you sell your asset, within 6 months you have to put that money in a fund, and then within a year the fund has to invest in a business or a project. So now this is the point where I usually start talking about very technical rules about if you put money in a business, the business has to be in an opportunity zone, but what if the business has other offices outside of the opportunity zone? How do you figure out if that's qualified or not? We could go through technical rules like that, but it actually, for me, it's more helpful to get a real example or at least a hypothetical example from someone and actually walk through how that would work. Actually, to answer that question briefly, if it's a business, at least 70% of the tangible assets of a business has to be located in an opportunity zone, and at least 50% of the revenue generated by that business has to be generated through activity within the zone. And that 50% test has 3 safe harbors. And so you can see why I don't want to get into the technical rules, because we could spend 5 minutes on that and nobody would remember. So what I'd like to do, first of all, is take a step back. There are 3 basic parties involved in every opportunity zone funding. There's the investor who's looking for the tax benefit. There's the fund that is going to invest on behalf of the investor. The fund has to be a separate legal entity. It can't just be me putting on a different hat and saying I'm a fund. You actually have to have an investment vehicle. So if you created a local fund, that would have to be an investment entity, and you'd have to solicit investments from local people and then invest according to a plan. So, but then you have your fund, and then you have your investee, your project or your business that's looking for money. So what I'd like to do, without making anybody stand up or anything, is that would you consider yourself an investee, somebody who might be looking for money? They have a project in an opportunity zone, or they're just generally a developer or a business owner that's interested in how the program works. Are there people like that here? Okay. And how many people would consider themselves investors? People who could see themselves selling an asset and then investing in an opportunity zone. Okay. And then who would consider themselves like a professional, in the sense of you might start a fund, you might be an accountant or a lawyer who would want to know how to advise people on doing this, or you're an economic development person who wants to understand how this thing works. Okay. So what I'd like to do is find an example, and this doesn't have to be a completely real example, but maybe a concept or an idea for a real estate development project. And what I'd like to do is take the basics of that and walk through what the developer has to think about, what the fund has to think about, and then what the investor is going to be looking at in terms of how they would try and take advantage of this. So does somebody have something like a development project that they're already thinking about maybe trying to do in an opportunity zone? And you don't have to give any information, you don't even have to use your name, just a kind of a concept. Yeah.
I'd say, say a parking lot, commercial parking lot located. Say a commercial parking lot located in the opportunity zone that has development potential for housing, mixed use, et cetera, and it has the dimensional characteristics to allow that.
So we have a situation where there's a property owned by a developer. It's currently a parking lot, and the idea is that you want to kind of basically tear down the parking lot and put in housing. What would you do in order to get that to the point where an opportunity fund would be interested? And potentially also what you would do as an investor if that came up as a opportunity to invest in. So the first thing where I usually start with these kinds of issues is that, so you're thinking about a fund is going to be the investor. So what is a fund going to look at? The rules say that a fund has a year to put money to work once it receives an investment from an investor. So what the fund's really interested in is getting an investor to put money in the fund so that they can make fees off of that. That's what fund managers do. So the fund manager is going to be looking for projects that are pretty close to being ready to go, because what they want to do is bring a project to an investor and say, here's a project, this is what it looks like. It's a 6-story multifamily housing project with retail on the bottom. This is where it's going to be located. This is how much rent it's going to generate. Here's the economics of the deal. This is how much it's going to cost. Give me money and I'll invest your money in this project. That's the role of a fund manager. So if you have a project like that where there's a standing parking garage and the city, for example, or a developer is interested in turning that into a mixed or a multifamily housing project, in order to be at the point where you can attract attention from a fund, you have to, I would say, if we were talking about this person to person, I'd say, well, you'd need to have control of the site as the developer. You'd need to probably have the site scraped. You'd need to have your permits in place. You'd need to have your pro forma in place. You'd need to have probably your other financing lined up. So if you're looking for bank financing, you'd probably need to have that in place. And you'd probably want to be able to say, we're ready to start construction within 9 months. And that would be a project that would be investment ready to the point where a fund would look at that and say, oh, okay, this is ready enough that I can go to an investor and have the investor give me money, because part of the issue for the fund is that you can't ask for money from an investor and expect them to sell their stock and then give it to you and then have that money sit in a fund for 2 years, because the person who owns the stock wants to wait until the last minute to get as much gain from the stock as they can before they sell. So it's all this whole timing exercise. So in that case, where I would probably, if I was approached by someone who had that question, I would start by sending him to the city and trying to maybe organize developer groups and really start to see where your planning is and what the timing is in terms of getting from the status of the project to the point where it can be investor ready. That may be 2 or 3 years. But if you know that, then you can start lining the pieces up so that when you get to that point, you already know who the fund is that you're going to try and attract, and you've kind of been working with the development agencies and all the other parties so that you can kind of arrange all those pieces so once it gets to that point, everything's totally squared away and it's an easy sell. So that's kind of how I've approached, and I've been approached in a couple of different cases with pretty much that same scenario in the housing area, but different stuff on the property. But it usually starts with site control, your financing structure, your development plan, and having all those pieces already lined up.
I have a follow-up to that. Can that scenario that you just described be done by the existing property owner, or does it have to be someone coming in and buying it and doing that project?
The existing property owner can do that. Yes. Generally, what you'd want to do is start a development company to develop that specific project. And the purchase of the land, so if you want to keep the land, then the investment would be in the building only and not the land. You could contribute the property to that. There are rules about what they call related party transactions. So if you invest in your own project, that's not permitted unless you own 20% or less of that project. So if you contributed the land to a group and you ended up owning 20% of the project, that would work. Or you could sell the property to a third-party buyer and then invest some of your own capital gain in there, but it'd still be a 20% limitation. Yeah.
Here you go.
But if I understand, and I may not, there's nothing in the fund that says what you're building on that parking lot needs to be affordable housing or needs to be low-income housing. He could build a fabulous new multi-family, charge $5,000 a month facilities, and it would still qualify under the fund, even though they're targeted low-income neighborhoods.
That's correct.
Awesome.
The program. Okay. Well, so what you need, so there, to kind of fill in a little of the blanks, there's on the kind of the public policy side, there, and you can argue whether or not the balance was struck properly, but the balance is between if you're going to ask private individuals to sell property they already own and expose that gain into something risky, how much, what's the likelihood that they're going to even decide to sell the property if they have to invest in something that's very risky? So the likelihood of an individual selling their Google stock if the only thing they could invest in was low-income housing would be pretty small as a practical matter. There would be certain people who would do that, but not very many. So they erred on the side of getting more money out into the economy rather than less. I think Ian and I both agree that as a public policy, as a community development tool, it's a pretty blunt tool. And so, because it's a tax incentive for investors. And so they want to make the incentive as incentivizing as possible to sell, which means you have to, limit as the investment opportunities as much as possible. So, yeah. Oh, and then I'll follow up.
Yeah, so this is particularly challenging when it comes to something like affordable housing, where you're purposefully limiting the upside, sort of the appreciation of the underlying asset. All of the juice in this program is on the tax avoidance side. So if the capital gains of the underlying investment are capped because you're trying to achieve a community development goal like affordable housing, then your tax benefits are likewise capped. So it's actually not a great tool for projects where you're trying to keep prices low because the upside to investors is going to be smaller.
And I'm sorry, I got a little follow-up, if you don't mind. The other issue about affordable housing is that if it's subsidized housing, so they use tax credit subsidies, low-income housing tax credits, is that it's very difficult to have an equity piece in that structure because of the way the tax credits work. And so it's very difficult, unless you're a big insurance company or bank, you can't even really benefit as an investor putting equity into a project like that. Same thing for solar and other kinds of projects where the slice that an individual would actually invest in doesn't actually generate any gain. So it's just very complicated. Anyway, I'm sorry to... Oh, okay.
So in either your experience or Ian's, have you ever partnered or seen cities of the size of Oregon City, approximately 36,000, partner or use this vehicle to help with their development? And if so, how did they do it? And how do they locate those investors to start that project?
Lots of different cities are in various stages of doing this. Part of the work that I've been doing is starting with the community and economic development folks and kind of working down to the ground level. There are a couple of ways that, well, I'd say a number of ways that communities are doing that. The first is very basically just kind of doing outreach to both sets of communities, both the business and development community and the investor community. In terms of investors, the best place to start is the usual suspects of the business groups like this, the Chamber of Commerce, bankers, accountants, lawyers, people who have clients who are at a stage where they're going to have assets that generate capital gain. Because the investor in this case is really the person who has some asset that they're willing to sell or are thinking about selling. And they might not even think of themselves as investors so much as asset owners. But I think that the outreach through those fairly traditional mechanisms work pretty well. Community development agencies knows the development community, and the business development people know the business community, and so it's an outreach process. And then I think another component that has worked in the communities that I've been talking to kind of in more rural parts of the state is literally, even if it's only 3 or 4 people in each group, bring some potential investors, some potential project owners, and a couple of accountants, because accountants are really handy for saying you can't do that, but you get them all at a table and you sit down and you kind of exchange information. Say, what is your project actually about? And is that something that this kind of investment group would be interested in? And use the dialogue process to really build a community of knowledge. based on actual transactions.
So have you seen urban renewal agencies use this tool effectively as a subset of their business plan to develop their community?
Again, I think that I've talked to a number of urban renewal agencies that are trying to consider that. If to step sideways a little bit, one of the trends in this area is local investors investing in local projects. I think when this thing first started, everybody had this view that it would be these big investment companies raising hundreds of millions of dollars and running around the country buying real estate. What's actually happening is that there's this bifurcated process, and local investment people, local property owners are really looking at it as, gee, if I sell this, family business that we were planning on selling anyway, I can reinvest it locally and get this tax break and do something interesting. Urban renewal agencies are trying to think about it the same way. There are some cities that are sponsoring funds, so a local opportunity fund. It has to be managed by a private entity because there's securities issues, but there are communities that are sponsoring opportunity funds, and I think that that's a good way to get the potential investor community engaged. It's taken some time, in part because the regulations rolled out pretty slowly. There are still some rules that are unclear, and so people have been hesitant to kind of jump in. But I think all of those tools are available. And I have talked to 3 urban renewal managers who are interested in kind of figuring out how to take advantage of this.
So you said the focus is primarily on real estate. Is that generally, are the most attractive investments usually residential, commercial, or manufacturing?
Single-family residential is very difficult. Multifamily residential is pretty attractive. There are funds, particularly national funds, that are looking for what they call workforce housing. So housing targeted for people between 60% and 120% of AMI. You can find funding for those. Commercial, I think commercial real estate commercial and multifamily residential are probably the most common. Industrial is kind of, the interesting thing about industrial is that it can either be a business investment or a real estate investment. So depending on how the company wants to do it, but there's some commercial activity, but I think that's limited because there's not a lot of industrial land out there. The reason it's more common with real estate is because investing in real estate is a relatively clean process. If you're doing real estate analysis, there's a pretty standardized way of doing that and figuring out what your potential return is. And you know that the property is in an opportunity zone because it's 100% right there. Businesses are more complicated. If you're a small business, manufacturing, some kind of a small business in an opportunity zone, that's pretty easy, but a lot of businesses sell outside the zone or they have satellite offices. It gets really complicated really quickly, and the analyzing a business as a good investment is always more complicated, so that's been slower to happen. We're working with a couple of groups that are trying to start funds for business investment. One of the interesting things about the program is that technically you could try and go out and raise $100 million for an opportunity fund, but in reality, most investors are only interested in putting money in a fund if they know where the money's going to go. So what happens is that both in the business area and the real estate, it tends to be you find a project first, and then you create a single opportunity fund just for that project. So you don't have a big pot of money. You have one fund for one project, and you raise money through the fund for that one project. So there are developers in Portland who are already, I know one that has 3 projects, and there's an opportunity fund for each project. So that tends to be, again, the easiest way to actually raise money for that. And it actually helps on the housing side because to try and create a fund to do, for example, workforce housing, it's difficult for people to wrap their heads around how do you judge the risk if you're putting money into a fund, but then who knows what the project is?
You said you knew someone who had 3 projects, each one with a separate fund. What's the transaction cost associated with creating that fund, administering it, paying the accountants and the lawyers to deal with it every year, file the tax returns? What's the cost of doing this?
They charge a flat fee for each fund. In their case, it's relatively low because it's a standardized fund document. They're raising money from people they already know, and it's the same accounting and administrative team, so it's all kind of, at one level, it's all through a single kind of cost center. It probably costs the investor about 1% on their total return over the 10-year period. Some of it has to do with because it's the developer who owns the fund, they're not charging fees to make fee revenue off of it. They're just charging to cover their cost, because their benefit is that they end up buying out the other investors at the end of the 10-year period and own the entire property outright is their model. So I don't have specific numbers for you, but the funds are the documentation costs them about $20,000 per deal because they have a standardized set of form documents that they do, and then it's probably about $30,000 a year to do the annual reporting and record keeping. So and the project size is usually about 12 or 15 million. So they're raising about $3 or $4 million in equity. So it's not, it's a cost, but it's not that expensive.
We have a question from the audience. I'm going to go ahead and throw it out
Okay.
to both of you. Yep, I'm right here. With the low barriers to create an opportunity zone fund, won't that create some competition as to dilute the amount of money that would be invested in any particular fund? And who audits the funds, or is there a need to have an auditor? And I think we've already answered, do investors need to be local?
I'll see if I can give a 3-part answer. Dilution is not a problem. Actually, raising money has been a problem. It turns out that a lot of assumptions about who would invest in funds and how they would raise money turn out to not be totally accurate. So it's actually been very difficult to get the stockholder who, somebody has a $5 million stock portfolio, to get them to sell a portion and invest in an opportunity fund. Their investment advisor doesn't like it, and the investor doesn't get it. And so those people are really not investing. The people who tend to invest in real estate deals are people who already invest in real estate deals and who understand it, or somebody who's gotten a huge they've sold a family business and they want to reinvest a portion into another business. So the dilution issue is really not happening. Now I can't remember the other 2 questions.
Well, do the investors need to be local? I think you already answered that one.
Investors can be, the fund can be national, it can be local, it can be regional. If you sell your Google stock and you live here, you can invest in a fund that has opportunity zone projects in New York. The locations are totally fungible as long as they're in an opportunity zone. And then what was the 3rd one?
Does it need to be audited?
Oh, if you are a fund manager and you're raising money from other people to invest in your fund, then that's generally a sale of a security. And so audited financial statements are part of your requirement, as well as following SEC regulations and being liable for malfeasance of various kinds. Starting a fund and raising money from third parties is a level of complication that you shouldn't undertake on your own. Very, very risky. You need accredited. You need somebody accredited through the SEC to do that kind of work. But there was something else that I thought of about the funds. Can't remember. Oh, you could get. So let's say those 5 people. you all said, hey, this is a really great idea, and we all know of a building that we would love to see redeveloped. Let's form a company, and we'll call the company the Oregon City Opportunity Zone Fund. You could all contribute to the company as partners. That would not be the sale of a security. So that could be an opportunity fund. So there are groups of people who already invest together who have started group funds where they just contribute money as, they end up being 20% owners in a 5-person company, and they use that money to invest in opportunity zone projects. So if you sell your house, you and your spouse can take the gain from that and put it in an opportunity fund and then invest in apartment building. So
I just wanted to make one additional comment about whether or not investors are restricted by geography. So they're not only are they not restricted by geography, you can invest anywhere, but what we're seeing is states competing against each other to some extent to sweeten the tax benefit to attract more capital. So there are other states who have really embraced this program, Washington being one, and I've heard of some other examples in the Southeast in particular, where they are layering on additional state tax incentives to encourage opportunity fund investment in their states as opposed to states that are less enthusiastic about the program. And so far, Oregon
neutral.
It's neutral. So we may be losing investment capital, for better or for worse, to some states that are more or less leaning into the program.
Yeah, and to follow up on that, funds, especially national and regional funds, will look to a state and say, in Oregon's case, there was some discussion about disengaging from the federal tax system, so that if you sold an asset and invested in an opportunity fund, you'd still have to pay Oregon state capital gains tax. The state decided not to do that. California, on the other hand, is not automatically tied to the federal system. So they have to actively pass legislation to say that if you make an investment in a fund, the same will apply in California for the state tax purposes. Right now, they haven't done that, and a lot of money in California is just off the table because for them, the tax benefit is great, but they have other ways of avoiding capital gains tax, frankly, and so to sell an asset and then still have to pay state capital gains tax, they can do a 1031 exchange and get the same basic tax benefit, and it's very simple and easy, and they don't have to pay any state tax. So it's Oregon, I think overall did the right thing, if only to at least keep the option open, because I think if the state had passed state capital gains tax, this room would probably be empty or close to it, because there's no real incentive to follow through. So anyway.
Okay,
So-
we have a few more questions.
Okay,
So
all right.
ready or not, here we come.
All right.
Okay. We focus mostly on bricks and mortar developments, but I have a question on if these funds can invest in combined capital and service development projects for a community.
Define combined capital and service. You mean building a building for an operating company, or?
Over there.
Yeah, that's my question.
Yeah.
I guess to use a potential example of, to use the funds to invest in developing, say, a residential drug treatment facility for families, and then, which obviously is a bricks and mortar component, but there's a kind of a service development component of getting that service ready so that it can draw down OHP funds to provide that service to the community. So it's the community need for drug treatment locally. Can these funds be used to kind of develop that together, or is it only going to build the building and then you still can't actually run the service yet?
It can be used for both.
Did
So
that get picked up? Could you repeat that a little bit?
yeah, well, so you build a building and also invest in the tenant or the service that's being done in the building, and you can look at it in a few different ways. You could do it as two separate investments. So you have a real estate investment that builds a building, and then you have people who are interested in the business, and they invest in the drug treatment center and basically provide working capital to build that out. I've been talking to a group that wants to take their childhood education program out to rural areas, and they're following that exact model where they're trying to create one fund to provide capital for the business, and then for each city that they move to, they'll have a real estate development project for the building, either build a new building or rehab an old one. So it's really just, if you think about it, it's just equity. And so anything that can attract an equity investment, this will work for, as long as you can find an investor who's interested.
Question here in the back.
Thank you for the overview here, but I'd kind of like to localize this a little bit.
Sure.
And talk about Oregon City. We're in the midst of trying to locate a economic development director, I think still. But I know Lori's here from our economic development department, and I don't know, Lori, if you're comfortable to talk about this or not, or maybe Tony, our city manager, could talk about what's happening in Oregon City, since we have two economic or opportunity zones here.
To start with,
Who wants to be put on the spot, Tony or Lori?
well,
Hey, wait. Hold
well,
on.
and to start with,
We're recording all this.
she and I have already been collaborating to try and figure out a kind of a systematic way of using this program in Oregon City. So identifying projects, kind of integrating it within more larger strategic plans, where's the best use, that kind of thing. So we've been having pretty constructive discussions about that in general already.
Yes, what he said. That's where we're at.
Well,
There are lots of properties.
The opportunity zones, it's a big portion of our city actually, and I can send a map out actually to Kent, and he can share with the group if everybody wants to see it. You could even just Google Oregon City Opportunity Zone map right now, and it would come up for you. But I'm happy to send it. Yeah.
And as a general matter, so kind of the theory that we started with was that if you can start with the economic development and community development team and start seeing ways that, because it's not anybody's fault, but the economic development groups tend not to think in terms of private sector capital, because they have incentives and resources that they try and coordinate, and it's kind of the developer's role it has been in the past to bring their own money. And so part of this is kind of bridging that gap, and that's actually how this presentation got off the ground in the first place, was that we've already started conversations like that. So,
Okay, we have some more questions. Does an investor need to meet any qualifications to participate in a fund?
they have to sell a capital asset and have capital gain and invest in a fund within 180 days to qualify. And the fund has, you invest your capital gain in a qualified opportunity fund, which means an opportunity fund that invests in a qualified opportunity zone, business, or asset. And that's kind of it for the investor. So the complication comes in, what is a qualified opportunity fund, or what is a qualified opportunity fund? What is a qualified opportunity zone business or asset? And you might think it would be simple, but it's not. And then also capital gains, there are different ways that you can classify capital gains, and so that side of it. The individual tax consequences is also like, you got to talk to your accountant about that stuff.
The 10-year time frame seems short. Is it 10 years from the establishment of the fund or some other criteria?
So it's 10 years for the program. So there's a couple 10-year periods. The program sunsets in 10 years from January 1, 2018. So December 31st, 2028 is when the program sunsets. You can invest any time in an opportunity fund, any time up to January or December 31st, 2028 and have 10 years to generate capital gains going forward. So technically, you can, on that date, you can put money in a fund, and if you leave it in the fund for 10 years, you get your tax-free gain on your investment in the fund, but then you can leave it in the fund until 2046 to continue. And then if you sell in 2044, so you put your money in 2028, you sell in 2044, all the gain inside the fund is tax-free. So it's potentially very significant as long as you're still alive.
That would be important.
That would be important.
So this one's kind of an in-between question concerning socially motivated investors. Are you aware of any funds specializing in earthquake retrofits for buildings within opportunity zones?
Well, that's a very interesting question because, two pieces to this. First of all, it's very, very difficult to generate capital gains from earthquake retrofits of existing buildings because the retrofit does not increase the value of the building at all. In fact, it turns it from an uninhabitable building to a habitable building, but you don't get any capital gain boost. So, plus the retrofit, if you're going to do this, the retrofit should probably be part of an overhaul rehabilitation of the project. If the retrofit was part of a larger rehab of an existing building, you may make some return at the end of 10 years, but it would be on the building itself and not on the retrofit. That being said, I'm going to make a little plug for a friend of mine who has come up with a design to retrofit low-rise non-reinforced buildings so that they can then put affordable housing on top of the building. And so the development of the housing on top of the building, the part of the construction cost is the actual retrofit. So it actually, from what I've seen, I think he's pretty close to proving out that you can get a rate of return on that. It's not a big rate of return, but if you're a socially motivated investor, you can get 5% on something like that and actually generate affordable housing. So that's the creative part.
So there's one, and correct me if I'm wrong, there's one loophole associated with structures that have been unoccupied for at least 5 years, I believe. So in those cases, let's say it is because it's prone to earthquakes, or it's falling down, or whatever happens to be the case. If it has been unoccupied, not used for 5 years, the value of the structure is marked to zero with respect to opportunity zone. So any money you put in it, whether it's for a retrofit or rehabilitation, automatically qualifies because you're starting with a basis of zero. But that's only the case with structures that have been unused, unoccupied for at least 5 years consistently.
As a city commissioner, I have a short question and a long question. The short question is we often use consultants. What's the cost of the SEC accredited consultant to guide us through this process? Range of values would be fine.
Best thing to do is hire a lawyer, because you're going to have to hire a lawyer anyway. So skip the consultant and hire a lawyer.
That was somewhat of a lawyer's answer. Okay.
Well, yeah, but I don't practice anymore, so there's.
Okay, so I have a more lengthy question.
Sure.
If a group, a city, a group of investors were creative enough that the city owned the property, we wanted to provide the infrastructure, we had made a previous commitment from a business to locate there if we give them what they need, could we bring in a private investor and we're going to provide the workforce housing if you so wish, in this, we could make that a component of the project. If a private investor were to be interested in creating a building, essentially becoming a landlord, I'm talking about making a total offering. I've seen some incredible economic directors, usually in the Southeast United States, that did this type of thing. Are those viable projects for this type of investment?
So what you're talking about is essentially building out all the horizontal infrastructure first, And then either selling them or giving them the property.
Well, selling
Sell-
it to,
sell it.
let the investor be the either landlord owner or
Yeah,
sell
sure.
it.
Because
investment.
essentially what, they're just buying the property as is at the time they buy it. If you build it out first and then sell it to them, that's a new acquisition for them and a new building that they're going to be building. So yeah, that's as long as it's as available as a private investment, that would work just fine. Yeah.
Well, another question, if a person invests in the fund and the person dies, but they will to their heirs the value of the investment, can someone inherit the returns tax-free?
So there's actually an answer to that question. So generally,
Good.
So first of all, kind of a little background in estate tax, which I used to do. It's one of the reasons I stopped being a lawyer. But so the basic idea is if you die holding an asset, the asset gets what they call a step up in basis to fair market value. So if, and probably some of you experience with this, you have a relative who dies owning a house, their heirs can sell the house with no capital gain tax because the IRS says, well, the basis or what they assume you spent on the house is now equal to its fair market value, so there's no gain. So what happens in this situation is that, and this is going to sound a little complicated, so I'll give an example. Somebody in an opportunity zone builds a $5 million building. Wait, is this going to work? Somebody's put $1 million into a new building, and an opportunity fund has invested in a building, and 5 years later, the person who invested in the fund dies. So during that 5-year period, the value of that person's investment has gone from $1 million to $1.5 million in that 5-year period. So when they die, the heirs get that interest in the opportunity fund, but it's valued at $1.5 million. So it gets a step up in basis to the value at the time they die. But the 10-year hold period still applies. So then 5 years later, if they sell any additional gain above so let's say from year 5 to year 10, it goes up by another $1 million. The heir can sell that building and get that whole $1 million tax-free. So the tax-freeness doesn't go away, but the period of time that you judge the amount of gain that's tax-free shortens, but it's still tax-free, if that makes sense.
Yeah.
So,
What about the capital gains that person put in? In other words, that $1 million is a capital gain. And he's going to, the tax breaks over the 5 and 7 years and stuff. So would the heirs still be able to take advantage of that? I mean, what you said for the income from it is what you said, but what about, am I being clear?
Yeah. So there's actually, to go back kind of, there's two main tax benefits. One is that when you sell an asset, instead of paying the capital gain tax on the year of sale, you don't have to pay the tax until 2026. And then, assuming you leave your money in the fund for long enough, you get a reduction in the amount you pay tax on. If somebody dies in 2024, the capital gain tax still has to be paid in 2026 because it was from a sale that happened a number of years earlier. The reductions still happen, that doesn't change at all because that's an income tax issue, and they've deferred the payment of a tax that was actually due here. You just don't have to pay it until over here.
All right, I think we have time for one more question. It just so happens we just have one more question. How do opportunity fund managers as equity owners interact with the other owners of the assets they invest in? For example, how do they impact decisions to sell the asset?
So if you can have a couple kinds of funds. You can have what's called if it's essentially built like a partnership, you can have what's called member managed, where all of the members equally manage the entity, or you can have a manager managed, normally in funds where it's a third where an individual is raising money from other people, that manager is not an investor in the fund. They collect, the standard terminology is 2% and 20%, so a 2% management fee and then what's called a 20% carry, which is like they get 20% of the total gain at the end of the investment period, and that's how the manager gets paid. So generally in a third-party fund, the manager is not an investor in the project itself. In the situation where you have a group of people who are kind of in a partnership, then they all manage together, which may or may not work out very well, but that's another issue. Yeah.
All right, I think we all know enough to be dangerous now. Stay tuned for part 2. Well, thank you very much, Ian and Stefan, for all that information. We really appreciate it. Thank you. Yeah. Good job. Thank you. So I like I said, when we first heard about doing a forum on opportunity zones, I go, I don't think this is going to fly. But obviously we had some excellent questions from everyone here in the audience. And again, hopefully you'll be here for a little bit longer to be able to answer each and every one of your individual questions, whether you want to be an investor, whether you want to create a fund, or be a manager, whatever the case might be. These are the guys you want to talk to. So next month, before we get to some announcements, we kind of have another follow-up theme that's very similar to this. We're bringing in John Tabagna, president of Econ Northwest, and he recently gave a presentation to the Portland Business Alliance on the impacts of an international trade war that could occur in our local region. I've personally attended some of his other conferences on how broken our land use system is in our state and some of his suggestions that he has to try to make some remedies to that. So I hope all of you are available the 4th Tuesday of next month, because I really feel he's going to be a wealth of excellent knowledge and information on topics that I think are very important to what's taking place in our economy today. Also, I want to introduce our new chamber. Is it president, executive director? Victoria, what do you like to go by? Executive director. Would you like to say a few words?
Hello, and I'm looking forward to meeting all of you.
There you go. No, she took Michael Brand's place, and so we're very happy to have you here, and we're hopefully see you at all our future forums as well. And then Lisa Davidson, where are you hiding out at? You've got some announcements you'd like to make about the community college's new programs?
We have been asking businesses what types of programs the businesses want, and so we now are offering professional development classes for businesses at the campuses. And for this term, we go by terms, but for September, October, November, we're seeing classes at Oregon City. Things like conflict management, we're doing customer service, mentoring, emerging leaders for those who are just starting out as new leaders. Project management is coming. So these are the topics that the businesses are asking for and have been asking for. And I just wanted to also mention that if you are not on our newsletter, the Connections with Business and Industry newsletter, we are updating you on classes that are coming, what's happening with Small Business Development Center. So you can either give me your business card and I can add you to the newsletter, or you can go on the website and you'll see a spot that says I am a business. Go to I am a business and get to Connections with Business and Industry, and you can sign up for the newsletter there. And that way you can keep up on what's coming. You can actually sign up for the classes online by pressing a button. So we want to know what you're interested in so that we can make sure that we offer those classes for businesses.
Great, great. There's always something going on up at Clackamas Community College these days. We're really excited to have them as a collaborative partner with the Oregon City Business Alliance. And Jerry, you have some things you'd like to share. We're co-sponsoring this with your Rivers of Life group.
Well, this is a joint effort between a whole bunch of people. You know, the 175th anniversary of the city, thanks to Lori and the city, is being celebrated this year, 1843. But you know, 50 years ago in September, Governor Tom McCall, David Rockefeller stood at Willamette Falls. Nobody knows about this. They don't talk about this. And celebrated the fact that Tom had initiated a process to clean up the river, and David wanted to know how to clean up the Hudson. By the way, both rivers are really restored. So we're doing, with the Business Alliance and Pamphlet Media, and Chef Wayne Filan, he's a nature chef, and under the auspices of Mount Hood Territory, our local tourism organization here in the county, we're doing the Legacy Tours on Saturday, October 28th, 2 tours, 9 a.m. and 1 p.m. with a salmon bake in between with really good food. Chef Wayne Filan, nationally known chef, is going to be helping produce that food. We're going to have the young people that you've seen, I brought here before, playing different roles of Tom McCall's administration. We happen to have today Tom McCall. Would you stand with us today, Tom? This young gentleman will play Tom McCall. Stafford Hansel, the pig rancher out of Eastern Oregon that set the agenda for Central Oregon and how the environment could be properly stewarded, will be there. L.B. Day, the Teamster boss, looked like Jimmy Hoffa, he'll be with us. These young people are playing these roles, so you'll see about 4 or 5 different people that had a difference, including Glenn Jackson, who did the alignment for I-5, made sure it benefited Oregon's businesses, the interstate freeway. He determined where it would go and what communities it would help support and businesses, and also Interstate 205. We'll have the young people playing those roles. We want to give you an opportunity to be on this trip. So thanks for letting us tell you about it. Okay.
All right. There's always something going on in Jerry's life. That's certainly the case. We certainly appreciate everything you do for our community, Jerry. So 2 little housekeeping things. There's white cards on your table. We call those comment cards. The green cards are our question cards. If you would like to give us some feedback as to how you felt about today's presentation, things that you'd like to see improved, things that you really enjoyed. Also, if you could give us ideas for future topics, we're pretty much set for the balance of this year, but we'd like to hear from you early on for other topics that you'd like to have us present on so we can start reaching out to potential speakers that would be experts in those fields. So if you could write that down. And again, for all of you that are new, we have registration packets to become members of the Oregon City Business Alliance. And if you decide to join between now and the end of the year, basically we won't charge you anything for your membership for this year. We'll go ahead and apply your membership dues for next year. So you get the bonus of being able to come September, October, November. We don't meet in December at no charge. So little incentive. We were talking about incentives earlier today. This is OCBA's incentive to all of you that aren't members. So with that being said, I'd like to thank you for coming today. A little warm out there. Go enjoy the sunshine. Summer is not ready to leave us yet, and we'll see you in September. Thank you.